Welcome to Money Secrets with Bill and Mike.
I'm Bill Alexander.
And I'm Mike Tove. Bill, what do you want to cover today?
Well, I think it's important that we cover life insurance. That's
Right.
so important for many families, and I think we need to tell folks how they can use life insurance to their great benefit.
And you know, and it's interesting because our backgrounds are somewhat different but related. I have financial services and insurance planning agency, so I get a lot of people coming through wanting to talk about life insurance and what kind of life insurance is appropriate and so forth. And you as an attorney, you have the same thing.
Well, I've practiced law for 40 years with
Yeah.
a focus on estate planning, which is another word for tax planning, as well as elder law and asset protection planning.
Right.
Of course, a lot of folks don't realize that life insurance is asset protected. Creditors
yes.
can't take life insurance away from you, and that's a very important point. But I guess we need to start with the basics.
Sure we do. So, you know, people don't, first of all, it's kind of interesting because there's a lot of confusion out there about the different kinds of life insurance. There's term, there's universal life, there's whole life, there's variable universal life, there's IULs, there's all different kinds of alphabet soup and stuff. So
there is,
maybe
and of course folks need to understand how certain types of insurance that they can use it for their benefit. Let's start with term. That's the very basic kind of insurance, and almost everyone has had term insurance.
So, well, why don't we do this? Why don't we take a short break, and then we're going to come back and let's break it down.
Okay.
We'll be right back. And we're back. So, let's break this down just a little bit. There's term insurance.
Well, and term insurance is very inexpensive, basic insurance, and most young families use that to protect from a catastrophic situation, the unexpected death, and they want to make sure that their survivor is covered, generally to pay the mortgage off, potentially to help the children through school, possibly to replace income for the surviving spouse, oftentimes. But those are basic needs.
But one of the things that, and I do a lot of insurance, as you understand, and one of the things that, even with term insurance, that we need to sort of clarify is a couple of things. First of all, and I tell this to clients all the time, is that in a way, term insurance is kind of a bet with an insurance company. You say, insurance company, I bet you I die, and they say, yeah, I bet you don't. So,
well, it is important for folks to understand that term insurance rarely pays off, and that's a good thing.
Yes, it is. But at the same token, it has a very specific need. And I think about insurance, term insurance, as filling a gap of where, if, God forbid, the breadwinner especially dies, the survivors, the spouse, the kids, whoever depends on them is going to be in a world of financial hurt without that person's ability to have a paycheck coming in. And one of the challenges, there's so many people out there that will just sell a single purpose term insurance like mortgage payoff. In other words, you die, you just pay off the house. Well, that's not really a good idea.
It doesn't do it.
And the reason it's not is, first of all, they weren't going to pay off the house in lump sum if they didn't die. Secondly, there's other expenses besides the house that have to be fulfilled. So I think of term insurance as being structured such that it's going to be enough money to replace whatever income that was lost.
Well, it is important insurance for families to have term insurance. Every young family should seek it. It's very inexpensive, but at the same time, it's just about that risk of the catastrophic situation that might happen to a family. Folks should know that term insurance only pays out about 1% of the time.
With that.
Well, it's very, very low, and that, like I said, that's actually a good thing.
Yeah.
That means we're living past it. But the other thing is that most term policies expire. In other words, you can't renew it at about age 70. Sometimes for some companies it's a little past that, but almost everybody lives past that. And so there's so many other reasons to have life insurance that term insurance just does not make the grade.
Right.
So in essence, families should be looking at not just term insurance, but term insurance is the baseline to get started with, and then add on permanent insurance after that.
One of the things, and this is a mistake that I see, and so if we're going to do a money secret, here is one to avoid. People have insurance through their employers. And that's great as long as they're working. But what happens to that insurance if suddenly they stop working, they get outplaced, they change jobs, or they get sick? And then all of a sudden, especially the latter, if they get sick and they have to leave work,
well, to me,
and then they die.
The life insurance that's provided by employers, I think families need to simply consider that supplemental coverage.
Yes.
It's not the baseline coverage that anyone should have because, first of all, in almost every instance, again, it's term insurance. It has no cash value. And so oftentimes it doesn't go with you when you either retire or if you move jobs. And of course, young people are moving jobs all the time these days. So employer insurance is simply only for supplemental. You should never count on it at all. So we really need to talk about, okay, so we get some term insurance, but is that really enough, Mike?
No. Well, it's that infamous question which has the same answer as it depends. I mean, I'm fond of saying that there's virtually no such thing as a universally true statement in all of planning, except there's probably no universal true statements in all of planning. And this is one of them. So you have to look at circumstances. What are the needs? And you know what's interesting is that the insurance companies actually have something that they call insurable interest, which means that if you're trying to buy a life insurance policy for no legitimate, justifiable reason, they won't accept it. They will say no.
Of course.
So there has to be some kind of a need. So term insurance is great if you have a limited need. Your kids are looking towards finishing their school and get through college, and once that happens, you're going to retire and everything is going to be hunky-dory as long as you can make it over that hump. That's a perfect example for term insurance.
I don't want folks to get caught up on insurable interest because most families would never consider buying insurance except for a family member.
Sure.
You're buying insurance on your own life for the benefit of your spouse and your children. You might be a grandparent buying life insurance for their grandchild or for their child. But I don't know of anybody other than employers who might provide it for employees that would even think about buying a life insurance policy on their neighbor or someone they don't know.
It also has to do. No, but it also has to do with the amounts, and so they won't just simply say, "Well, we're just going to sell you a $10 million insurance policy because you want to buy one."
Well, you know, the Internal Revenue Service they do have guidelines on that, and in fact, life insurance is something where they limit you, and part of the reason is because it's an extraordinary opportunity for families, and it wouldn't be limited otherwise.
Okay. So let's take a short break, and then we'll come back and let's explore some of those areas. So, we're back. Bill, why don't we talk a little bit about permanent insurance?
Well, I think it's important because that's the kind of insurance that you can always keep. And there are multiple ways of actually strategizing how to pay for it.
Sure.
I mean, most permanent policies you can pay in premiums for the rest of your life, or you can pay for a number of years and it'll then pay for itself. So there are a lot of different things, but you might want to talk about why people buy permanent insurance.
You know, well, there's a couple of things. First of all, I recommend permanent insurance to anybody who doesn't know how long that insurance need is going to be there. For example, if somebody says to me, well, if I die, my pension doesn't go to my spouse or this or that, or they're going to, we don't know how long the need into advancing years might be. That's a reason for permanent insurance.
Well,
for estate planning purposes, your area of expertise.
Absolutely. Well, you know, people buy life insurance for a number of different reasons, but one is to make sure that they can pay for any estate tax liability upon their death. And this is particularly true for business people that have most of their money tied up in their business. In other words, they don't have that much cash available, but their worth, you know, their net worth is high, but they don't have the liquidity to pay the Internal Revenue Service within 9 months upon their death. So they buy life insurance in order to cover.
Well, we got to be careful about that too, and you know what I'm coming to, because life insurance is income tax exempt, the death benefit, generally speaking, but that death benefit, if you own it, that's
it's part of your estate. So obviously there are two ways to avoid that. One is to have what we call a life insurance trust, which is an irrevocable trust, and we've used those, that work. Or there's what I call the cheap man's trust, which is to make your children the co-owners of the policy, and that works as well for many folks.
It's actually a very common strategy, but there is a catch, and you have to be careful about how you set it up. You can't just...
Well, how you pay for it, you do need good professional advice on how you set up that kind of policy and how it is paid for, because if you do it wrong, it can cost you an additional tax dollars, and it's called gift tax, and with penalties and interest. So it's very, very important as to how a policy is set up.
And
of course, the other thing that we hadn't talked about that we really need to go back to is, and that is, the younger you get a policy, the better, because unfortunately, as we get older, our bodies don't work quite as well.
Yeah, I noticed that this morning when I got up.
Well, the problem is that we have to convince the insurance companies that we're still a good risk, so that they will actually issue a policy.
Right.
And when we're younger, we tend to be healthy, and so.
Well, it's not just that. It's also when we're younger, we also have more years in which we're going to stay healthy.
Absolutely. And of course, there's another reason that folks purchase life insurance, and that is, you said it yourself, to make up retirement benefits where you elect to, you're still in good health, but you're reaching retirement, and you have an option. You know, if you have a pension, and of course those are going away for a lot of folks, but if you have a pension and you elect to take 100% of it, if you die first, your spouse doesn't get any of it.
Right.
And that's not particularly good planning for your spouse for many cases. Now, then this is where people who are getting ready to retire really need to see a professional to determine if life insurance is a better option for them rather than reducing their pension so that their spouse gets a benefit.
You know, and that's an interesting point, and that is a mathematical thing. But if you have a pension that pays a certain amount of dollars to you, but it pays a reduced amount of dollars to you and a spouse, does the difference in income create enough income extra to pay for a bigger life insurance policy for the spouse if you died? And there are ways of actually calculating which strategy is more efficient in the long term.
Well, a big part of it for me, I mean, and this is no-brainer type of stuff, is the fact that if you and your spouse are about the same age, then oftentimes, as long as you assume that your life expectancies will be similar, then life insurance is always going to outpace the reduction in the pension.
Right.
And that's what a lot of folks don't realize is that, and of course it's based on calculations, but that oftentimes if you're still in good health at the time you retire, then that is an extraordinarily powerful way of getting more money to your family upon your death.
Or even in situations, for example, where you have a tremendous disparity in age, 8, 10, 12 years, and the younger spouse is the big breadwinner.
Mm-hmm.
That's where you really get some huge benefit from looking at this. But it's always about, you have to take it in consideration of individual needs and circumstances.
Well, Mike, when we come back, what I'd really like to talk about is how families can use life insurance. Sometimes it's because you're buying it for your children or your grandchildren.
Well,
but there's some very powerful ways
yes.
to use life insurance and a real need for those family members.
Oh, yeah.
And if they get it at the right time, it's actually an unbelievable money secret.
Yes, it is. So we'll be right back, and we're going to cover that one. Just a minute. And we're back. So, you know, Bill, you were starting to introduce a topic, and this is one that I'm particularly fond of because it's probably one of the biggest money secrets that's out there.
Well, I agree. You know, life insurance is one of the pure investments that's still tax sheltered. You know, what you invest in a life insurance policy accumulates tax free. You can borrow against it tax free as long as it's a pure life insurance product. And the death benefit is paid out tax free. So the only tax consideration you even have to worry about is whether or not you have a taxable estate and how you set it up. But if it's set up properly, it's a fabulous kind of thing.
But this is where we get to some fun stuff, because so many times people come in and say, well, I don't like life insurance because I have to die to get it, and I don't want to die, kind of thing. And yet they don't realize that they can use life insurance. Yes, the death benefit is always going to have to be there, but they can use life insurance for the cash value, not so much for themselves, although that is doable if they start younger, but especially for their kids, their grandkids.
Well, you know, the CPAs 30 years ago may have had a good point that you might be able to make more money just with good investments, but not anymore. You know, life expectancies have risen considerably, and at least from what I've seen, is life insurance policies have become far more competitive, so they really can be very good investments.
So let's talk about this. So the way it works is that one sets up a life insurance policy in the name of a loved one, a child, a grandchild.
Well, and what I have actually talked to folks about, particularly well-to-do parents and grandparents, is to look at a life insurance policy when the child is born.
Yes.
Because the earlier you set it up, the longer period you have for it to grow.
And what we use a special, I use a specialty kind of life insurance that grows cash value and really explodes it upwards.
Well, folks need to understand that life insurance policies can be manipulated, if you will. I mean, it's not all about death benefit. It can be, a policy can be structured to grow cash value as opposed to simply have it for death benefit. And that's really important.
Because the secret there is that when that beneficiary reaches a point of projected retirement, 65, 70, whatever that might be, the cash value in these policies for a fairly modest sum in the premium phase way back when has grown to $1 million, $2 million. Well, it has the basis of being tax-free income.
I just reviewed a case for a grandfather, and he was paying $5,700 a year for 7 years, but for an 8-year-old son who was in excellent health, of course. And the bottom line is with this particular illustration, when that child reached 70 years of age, the child could borrow $100,000 a year for 20 years. So at age 90, that policy would still have almost $2 million in it for that child's children. So certainly a way to perpetuate a legacy.
I've looked at a similar one that for $250 a month for 20 years on a 5-year-old, the projected cash value was $1.25 million. at age 70.
Well, what I've seen is the earlier that you get started, the more powerful it can be. And our young kids just are not going to have the opportunities that we have enjoyed.
No. So we'll be back and we'll wrap it all up. And so, Bill, let's wrap this one up. I mean, life insurance planning certainly got a lot of components to it. People need good counsel on this. This is absolutely not something to do with because the operators are standing by call today.
Right. The money secret for the week has to be that think of life insurance as a multi-tool. You can use it for so many different things. You need good professional advice on how to get it, what you should be looking for, and how you can use it very powerfully. But parents and grandparents need to be thinking about it for their children and grandchildren, not just for themselves.
And of course, the other thing is that it's a process. You go to someone, they will run a series of illustrations for you. It's massageable, it's tweakable. It's not here it is, take it or leave it. This is what we're starting with, but let's keep working it and massaging it until it gets to be the right combination.
Absolutely. Well, it's an important money secret for families. And I'm Bill Alexander with W.G. Alexander & Associates. We're located in Raleigh, and our law firm focuses on estate planning, elder law, and asset protection.
And I'm Mike Tove with AIN Services. You can reach my website at www.ain-services.com, or our phone is 800-363-2296. And Bill, you have a radio station.
I do. I'd love for folks to listen to me at 11 o'clock in the morning on WPTF, that's AM 680, for Asset Protection Today.
Thanks for watching.
See you next week.